Rahul Chadha, Co-Chief Investment Officer with Mirae Asset Management, joins us. Rahul, good morning. Thank you for joining us. Is the India story getting slightly sour, Rahul? Because we are underperforming and earnings are not there and valuations are not that attractive. So clearly, I mean, either investors, they buy potential of earnings recovery or they buy attractive valuations. If they both are amiss, then what happens?
Yeah, I think what key reasons India started underperforming was, I think, from mid-Jan onwards, once we had the talk of SP, BSP combined, and there was some bit of an uncertainty on elections outcome. Look, if the ruling party doesn't come back to power, the next best alternate from what people are predicting here is a third front, and I think which is really not very comforting for markets, for foreign institutional investors, and that's where people are taking a wait and watch attitude. On the other hand, what's happened is with this talks of a trade deal coming between China and US, with Fed sounding more dovish, things seem to look much better for China and Korea, where valuations were attractive, and I think that's where some of the flows are going.
Do you think now it's a time to re-enter India after the recent bout of underperformance, or you will take an overweight stance only after the elections?
I think what happens is if this level of underperformance continues, somewhere the election uncertainty would be baked in the prices. So going into April, May, markets would be pricing in some of the uncertainty on account of elections. Earnings traction has not been that bad. If you look at corporate banks, things been on track. And if you look at, let's say, IT, things are okay. Where the pain point is consumption, where the pain point is some of these NBFCs. But outside, broadly, earnings on track. So I think 2-3 months of underperformance of India compared to region should price in this uncertainty on account of elections.
Rahul, morning. So, in this uncertainty, would you say that the worst is behind us, or would you say that the index will continue to be range bound, about 10,100 or on the lower end, and maybe 11,100, and we'll continue to beat around in this 500,000 odd kind of band?
Yeah, I think it will go on for next couple of months, and as we get some bit of these opinion polls, as we go closer to the elections, people get a better handle on what the outcome is. That's when we'll see the breakout. Till then, I think it's going to be a fairly range-bound market.
You've spoken about how the picked up in discretionary consumption due to market share gains would be a big beneficiary for the consumption sector as a whole. But then there's that argument with the expensive valuations. Do you like the space? Are you comfortable buying into the consumption?
Yeah, no, I think there is select plays in that space. We've seen again some of the fast food restaurants do well. They've kind of done well with the SSG growth. We've seen names like Titan do well, where it's more of a market share gain story. I think what's taken a breather here is autos, and that's you can attribute a part of it to the financing crunch which happened. You can attribute it part to the consumer going in a shell for a couple of quarters. So one's got to be selective over there. I take your point. Consumption would be a multi-year story, but near term, I think it can be soft for next couple of quarters.
Sorry, I missed that, Rahul. What within consumption were you saying is going to be soft?
Again, autos looks slightly soft. Consumer durables looks soft for at least next 2 to 3 quarters.
You have to invest the classic way, which is that, buy today, don't worry about election, don't worry about what will happen to all the, macro and the political tensions. You said that, look, I'm going to take a bet on India, and this is a 3 to 5 year theme. Doesn't matter if I lose 5%, it doesn't bother me if there is a 15% volatility. What would you like to buy in this portfolio? Which are those classic businesses, classic compounders, where you say, look, I'm a buyer, and more than a buyer, I'm a believer for next 5 years?
Okay, so one looks at big businesses which are attractive from a 3-5 year perspective. I think some of the corporate banks, post the management changes, post the NPA recognition, look fairly attractive from a risk-reward basis. What looks also attractive is some of the life insurance names. These names have underperformed. Look, if one takes a 3-year view, there is a long room to go for protection business to grow. So I think that's attractive. PSUs are selectively very attractive there. I think what's happened is this central ETF things has done more harm than good to the sector. Government's met its divestment targets, but the stock's been hammered because the arbitrage just come and play in these stocks. But what it creates is great value from a long-term investor perspective. So select PSUs, insurance, corporate banks is where deep value is. And outside that, then it becomes very, very selective. Like the Titan example we gave, so the other consumption names look attractive, basically.
What is your understanding of the NBFC liquidity situation? A, for NBFCs, and B, for the system at large. Is there a time bomb in ticking, or there are liquidity issues which have been sorted out and now it's back to normal for the entire NBFC stroke, the sectors which are dependent on NBFC funding?
I think it would take a couple of quarters things to sort out, because what we'll see is slowly some of the mutual funds, some of the private banks cut on liquidity to these NBFCs. Though the central banks clearly come out and said that they're going to prevent any of the systemic crisis. That doesn't happen. But in near term, I think liquidity overall gets impacted. One would be surprised to see any of these NBFCs grow beyond 10-15%, leave one or two aside. But broadly, the system would be flat or degrow. And I think that's where consumption also gets impacted, because a lot of these guys were lending, were aggressive lenders in the market.
Rahul, in your notes, you've mentioned that, there are some economy-oriented companies which are available at attractive prices. Aside of corporate banks, which is, I guess, the consensus trade on the street, and it's almost a fad right now, what else do you find of interest?
Okay. I think selective cement may be interesting. Because look, this is a sector which is underperformed. We've seen one of the large industry players care more about market share than pricing. Those things should kind of change in coming quarters. We've seen demand which has held on very well. The worst of the cost pressures are behind us. So from an industrial recovery perspective, I think cement should do well. There's a big focus from government on rural housing. Urban housing is very attractive. Again, because of the liquidity issues, didn't pick up, but hopefully should do well with all this GST rate normalization. So one would look at cement. And outside that, domestic cyclicals, again, should pick up. But election is a big election outcome is a big issue or a big variable over there.
Right. What about what's going on with China? Do you think that there is some sort of merit in the metal sector, or do you believe that given the kind of volatility that we're seeing globally, you'd be a little bit skeptical on this space?
Yeah, I think what's happening is China is also selectively giving credit in the economy. If things get too slow, they open credit tabs. But at the same time, the broad policy is more towards deleveraging, controlling the credit growth, controlling the FAI growth in the economy. Globally, one's not sure where the economic cycle peaks. It's early 2020 or not. So there is value in metals. But look, I think it's really the uncertainty which would keep investors away from the space. So one would rather pick banks over metals. One would rather pick something like a cement over metals to play the recovery.
Okay. Rahul, where do you think you are now getting slightly disenchanted with the earnings? Where do you think you were hoping for earnings recovery and the earnings recovery is just not there, and now you're thinking that, has your thesis not worked the way you thought?
Okay. No, I think consumption that one would get a much longer kind of an headway for growth. One saw good set of earnings which came last year, June quarter, but things got fairly slow in the festival season. So festival season, which was expected to be one big festival season post the demon GST, never really failed to kick off because one had the NBFC crisis around that time. So I think that's been the disappointment that, look, normally you need 2-3 years of good, strong growth. And that's not happened in last kind of a regime.
Rahul, I'll also like to draw your attention to what is happening on the corporate governance standard. I mean, I'm a big bull, so don't get me wrong. But the Indian companies always enjoyed a premium for excellent degree of corporate governance. That explains why foreign investors were ready to pay a top dollar premium to buy Indian companies. But when you see an episode in Sun Pharma, when you see an episode in SL group of companies, when question marks have been raised about the debt servicing of Adani group of companies, it just makes you wonder that are Indian companies or are Indian stocks worth that price? Because you're buying gold at the price of gold. This is not Chinese stock markets where growth is high and valuations are attractive.
No, you're absolutely. This is our investors ask us. Look, you've always kind of highlighted the corporate governance of India, and that's where you've got the top private sector banks in India trading at 3.5 times books. This is not 0.5 times book for China. So that's where high standards have to be maintained. I think the changes in private sector banks help, but clearly, all those groups names which you mentioned get asked by investors time and again that look, where is this going? Hopefully these are changes which happen, changes for better. But look, India enjoys a significant premium over the rest of the region, and that premium comes because of high quality governance. So we hope that high quality governance remains maintained. Else stocks would get derated. I mean, whether it's on a macro front or a micro front, if we don't keep up the high standards, again, markets are ruthless.
Contra buyer in the telecom space, or are you worried with the kind of data that just emerges with Reliance Jio? Yet again, they've beaten incumbents, they've topped their market share. 30% revenue market share is what Jio is currently commanding. The Idea Vodafone merger now has taken place. Do they stand a chance?
Okay, this is a space one to be closely watched.
Yeah.
Because clearly Reliance has interest in the retailing space also, and or e-commerce, and that's where they're up against big boys like Amazon, Walmart, etc. So if in next 1 or 2 years they take the call that look, the ROEs are better in the e-commerce retailing space, that's a better kind of an opportunity from a next 5-10 year perspective. Hopefully there's less pressure on the telecom space, and I think that's where telecom becomes attractive. So the industry is consolidated. It's just that you need some sanity to play around. And with what's happening with one of the largest players over there, that they've got multiple options for growth. If, like the way I said, they choose retailing, I think we should see telecom become attractive again.
Rahul, the most important question right now is that what exactly are markets factoring in from the election cycle? And I'll phrase this very carefully and slowly. Do you think at the current level, markets are betting on a return of current administration? That's A. B, the current administration comes back with an outside majority or outside support, or C, a change of government. What exactly do you think markets are pricing in out of the three scenarios I mentioned?
Okay. I think what the market is pricing today is up to your second scenario, where the current kind of when government comes back, but comes back with much lower seats, comes back with outside support. So that's really something markets are pricing in. Markets are not pricing in change in government. I think first of all, that pain would come in rupee, which can easily depreciate by 5% if we have a third front government. So I think your second scenario is more likely priced in at today's level.
And how exactly are you preparing your portfolio to deal with election volatility? Would you be looking at raising cash or buying puts or going short?
Yeah, I think these exporters, 20-25% of the portfolio. One is still kind of more predisposed towards large caps at this point of time. Though select mid caps, small caps are attractive, but one is not looking to increase significant positions so that in the run up to the elections. So it's more of a large cap, strong companies which can withstand 2-3 years of volatility should the government not be voted back to power.
Okay, Rahul, great to have you on the show as always. Thanks so much for taking the time out and speaking.